If you are looking at the current spot price on your screen and believing that it represents the actual reality of the global silver market, you are being completely blinded to the most massive and unprecedented wealth transfer in modern economic history, because right at this very moment, the vaults of the Comex are being drained of physical metal at a velocity that has never been witnessed before, setting the stage for an explosive upward trajectory that will inevitably shatter the $100 barrier. The paper market is an intricately designed illusion, a carefully orchestrated matrix of synthetic contracts that completely masks the terrifying physical deficit unfolding behind closed doors, where smart money, institutional giants, and sovereign entities are quietly and aggressively vacuuming up every single available ounce of physical silver they can get their hands on. You are standing on the precipice of a historic supply squeeze, and the window to position yourself before the general public wakes up to this catastrophic shortage is closing by the second, meaning that those who wait for mainstream media confirmation will be left buying at exorbitant premiums when the metal is practically unobtainable. When we peel back the layers of deception and look strictly at the raw data coming out of the commodity exchanges, specifically the registered category of silver, which is the only metal actually available for immediate physical delivery, we see a terrifying chart that looks like a waterfall heading straight to zero. For decades, the system has relied on the assumption that only a tiny fraction of contract holders will ever stand for actual delivery, allowing bullion banks to leverage their positions by selling hundreds of paper claims for every single ounce of real silver sitting in the vault. But that fractional reserve paradigm is entirely breaking down right now, as investors have lost faith in fiat promises and are demanding their physical property, creating a cascading run on the vaults that the exchange operators cannot physically satisfy because the metal simply does not exist at these suppressed price levels. The mechanism of price suppression that has kept silver artificially cheap for decades is finally unraveling because you cannot print physical elements out of thin air, and the banking cartel that has historically maintained control through naked short selling is now trapped in a nightmare scenario of their own making. As the physical vaults continue to empty day after day, week after week, the leverage ratio between paper contracts and physical reality is stretching to a breaking point that will ultimately trigger a force majeure event, where the exchange will have to cash settle contracts because they cannot source the metal. Once the market realizes that a paper contract does not guarantee physical ownership, the ensuing panic will instantly decouple the real physical price from the manipulated spot price, sending the cost of securing actual silver skyrocketing toward the $100 mark almost overnight. This impending supply crisis is not just driven by investment panic, it is structurally cemented by a catastrophic industrial deficit, primarily fueled by the unstoppable global transition toward green energy and the absolute explosion of the photovoltaic solar panel industry. Every government on the planet is currently injecting trillions of dollars into net zero mandates, and modern high-efficiency solar panels require significantly more silver paste than previous iterations, meaning that this single sector alone is on track to consume an overwhelming percentage of the entire global annual mining supply. There is no viable substitute for silver in this application because it is the most conductive element known to mankind, and solar manufacturers are being forced to aggressively secure their supply chains right now, regardless of the price, which is pulling massive tonnage directly off the market and away from the vaults. In addition to the massive solar drain, the electric vehicle revolution is acting as a massive secondary vacuum for global silver inventories, as the automotive industry completely transforms its production lines away from internal combustion engines. An electric vehicle requires dramatically more silver than a traditional car, utilized extensively in intricate battery management systems, advanced sensors, autonomous driving relays, and virtually every electrical connection throughout the vehicle to ensure safety and efficiency. As global mandates force the adoption of millions of new electric vehicles onto the roads every single year, the automotive sector's demand for raw silver is compounding at an exponential rate, further exacerbating a structural deficit that the mining industry is entirely incapable of satisfying. Beyond green energy and electric vehicles, the absolute explosion of artificial intelligence, advanced computing, and next-generation military technology is creating a silent but massive drain on the highest grades of industrial silver available. The massive data centers required to power AI language models, the sophisticated microchips running supercomputers, and the advanced targeting and radar systems in modern defense applications all rely heavily on silver's unmatched thermal and electrical conductivity. These high-tech sectors are entirely price inelastic, meaning that whether silver is $20 or $120 an ounce, they must purchase it to manufacture their products, and they are currently securing long-term physical contracts that bypass the open market entirely, leaving even less metal for retail investors and exchange inventories. While demand from every conceivable sector is going absolutely parabolic, the supply side of the equation is an absolute disaster, trapped in a decade-long stagnation with peak silver production likely already in our rearview mirror. You must understand that silver is a highly unique commodity because roughly 70% of it is mined purely as a byproduct of extracting other base metals like copper, zinc, and lead, meaning that even if the price of silver skyrockets, primary silver miners cannot simply flip a switch and double their output. Discovering a new deposit, navigating the endless environmental permitting processes, and actually building a functioning mine takes well over a decade and billions of dollars in capital expenditure, guaranteeing that there is absolutely no sudden influx of new supply coming to save this completely imbalanced market. The absolute clearest indicator that the Western pricing mechanism is fundamentally broken is the massive and sustained divergence known as the China premium, where Eastern markets like the Shanghai Gold Exchange are consistently pricing physical silver dollars above the Comex spot price. This is not a temporary anomaly, it is a calculated and aggressive strategy by Asian nations to physically drain Western vaults through relentless arbitrage, offering higher prices to incentivize the flow of real metal from London and New York directly into Eastern depositories. China is aggressively hoarding essential commodities to insulate their economy and military from Western sanctions and supply chain disruptions, and their willingness to pay a massive premium is bleeding the Comex dry, acting as the ultimate catalyst for the impending global price reset. This massive wealth migration from west to east is deeply intertwined with the broader macroeconomic theme of de-dollarization, as central banks and sovereign wealth funds around the world aggressively dump Western debt instruments and rotate into hard, tangible assets that carry no counterparty risk. While gold has traditionally been the primary focus of central bank accumulation, sovereign entities are increasingly recognizing the strategic necessity of hoarding silver, not just as a monetary hedge against rampant fiat currency debasement, but as a critical strategic resource required to maintain their technological and industrial independence in a fracturing global economy. When nation-states begin competing with industrial powerhouses and retail investors for a rapidly shrinking pool of above-ground silver, the resulting bidding war will make the projected $100 price target look incredibly conservative. We are operating in a macroeconomic environment characterized by deeply entrenched, sticky inflation that is structurally destroying the purchasing power of every major fiat currency on the planet, forcing capital to seek safe havens that cannot be printed by central banks. The historical playbook dictates that during periods of severe currency devaluation and loss of faith in government debt, precious metals undergo massive upward revaluations to account for the expanded money supply. Silver is currently sitting at an absurdly low historical ratio compared to gold, and when the inevitable reversion to the mean occurs, silver will behave exactly as it has in every past monetary crisis, acting as high beta gold and violently slingshotting upward to reflect the true devastation of the fiat currency system. Adding maximum fuel to this incredibly volatile macroeconomic fire is the dramatic escalation of geopolitical conflicts and the re-emergence of the war premium, which historically drives massive amounts of panic capital into safe haven assets. When global supply chains are threatened by regional wars, shipping lane blockades, and escalating trade tariffs, industrial manufacturers absolutely panic and begin hoarding critical raw materials to ensure their factories do not shut down. This panic hoarding by massive multinational corporations completely short-circuits the normal supply and demand dynamics, instantly stripping the remaining inventory from global exchanges and forcing the price discovery mechanism to violently adjust to the upside. The math underlying the current market structure is completely unsustainable, as the world has essentially been running a structural physical deficit for several consecutive years, consuming significantly more silver than is being pulled out of the ground and recycled combined. To cover this massive annual shortfall, the market has been cannibalizing above-ground stockpiles and draining the exchange vaults, but this is a finite game that is rapidly approaching its mathematical conclusion. You cannot run a deficit forever when the underlying asset is an essential, highly consumed industrial commodity, and when those accessible above-ground stockpiles are finally depleted. the price will have to rise exponentially to a level that either destroys demand or miraculously incentivizes impossible new mining production. What the mainstream financial analysts continually fail to grasp is the psychological tipping point that occurs when the broader retail public finally awakens to the reality of the physical shortage and the completely empty vaults. Currently, silver remains an incredibly niche, contrarian investment ignored by 99% of the population. But once the mainstream media is forced to report on industrial shortages and the failure of exchanges to deliver physical metal, massive retail FOMO will ignite. When millions of average investors try to squeeze their capital into a market that is already completely devoid of physical inventory, the resulting buying panic will overwhelm the bullion dealers and completely shatter the paper pricing illusion once and for all. We are rapidly approaching the phase of the market cycle that industry insiders refer to as unobtainium, a terrifying scenario where the quoted spot price on your screen becomes entirely irrelevant because nobody is actually willing to sell you the physical metal at that fictitious number. During this phase, you will see massive premiums develop on physical coins and bars, where a dealer might demand $40 or $50 over spot just to part with an ounce, completely exposing the fraud of the futures market. At that point, the big institutional players who are heavily short paper contracts will be forced into a desperate short squeeze, buying back contracts at any price necessary to avoid default, which is the exact mechanism that will act as the final rocket fuel to propel the price beyond the $100 threshold. The energy crisis is also playing a massive, understated role in the coming silver explosion, as the cost of extracting, milling, refining, and transporting dense heavy metals is entirely dependent on the price of diesel fuel and global energy inputs. As geopolitical tensions and underinvestment in fossil fuels drive the baseline cost of energy permanently higher, the all-in sustaining cost to mine a single ounce of silver is skyrocketing, effectively establishing a continuously rising hard floor under the price of the metal. Miners will simply shut down operations rather than sell their depleting reserves at a loss, which means that the era of cheap silver is mathematically and physically over, permanently altering the supply economics in favor of significantly higher valuations. It is absolutely critical to understand that the current suppression of the silver price is actually the greatest gift possible for those who understand the underlying fundamentals, because it allows you to accumulate real tangible wealth at a heavily subsidized discount right before the system inevitably fractures. Every single time the paper market is slammed down by synthetic selling, it accelerates the physical drain from the Comex, effectively hastening the arrival of the ultimate squeeze and ensuring that the subsequent price explosion will be even more violent. The manipulators are trapped in a vicious cycle where their attempts to maintain control only accelerate the exact physical shortage that will ultimately destroy them, and smart money is using this artificially extended window to load the boat. When you analyze previous historical silver squeezes, such as the Hunt brothers in the late 70s or the massive run-up in 2011, they were primarily driven by investment demand and monetary fears, but the current setup is infinitely more explosive because it is anchored by desperate, unavoidable industrial consumption. In the past, high prices eventually incentivized people to melt down their silverware and jewelry, flooding the market with secondary supply. But today's silver is being consumed in microscopic quantities inside billions of electronics and solar panels, meaning it is economically unviable to recycle and is effectively lost to the landfill forever. This permanent destruction of the metal means that the supply elasticity that ended previous bull markets simply does not exist today. The transition from a paper-dominated pricing scheme to a physically driven market will not be a slow, orderly process. It will be an incredibly violent overnight repricing event that will leave the vast majority of investors completely stranded on the sidelines. Once the Comex registered inventory falls below a certain critical psychological threshold, a cascading bank run will occur as every entity holding a paper receipt rushes to secure the actual metal before the vaults are declared officially empty. This will create an unprecedented bottleneck, a massive short squeeze that will gap the price up in incredible increments, skipping right past intermediate resistance levels as panic buying overwhelms the market with absolutely zero available liquidity. This is the exact moment in history where fortunes are made by those possessing the foresight to look past the manipulated paper charts and recognize the fundamental physical reality of an emptying vault and an unstoppable wave of industrial demand. The data is entirely unequivocal. The supply chain is fractured, the green energy transition is consuming everything, and the Eastern powers are aggressively draining the remaining Western reserves. The target of $100 is not some arbitrary fantasy number. It is a basic mathematical necessity required to balance a market that is fundamentally broken, and standing in front of this inevitable macro trend is the single greatest asymmetric investment opportunity available on the planet today. The countdown has already begun, and every single ounce of physical silver that leaves the Comex vault brings us one day closer to the ultimate shattering of the paper illusion and the historic upward revaluation of the metal. You cannot afford to wait for confirmation, you cannot afford to trust the manipulated spot price, and you certainly cannot afford to ignore the massive macro forces aligning to squeeze this tiny market into oblivion. The vaults are emptying fast, the panic is quietly brewing behind the scenes, and when the dam finally breaks, the subsequent surge to $100 and beyond will happen with such ferocity that only those who are already physically positioned will reap the generational wealth that is about to be unleashed.